Today was bad. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the biggest market crash since 2008 just hit Asia. It started in overnight trading with Hong Kong. It affected European equities, and then during U.S. markets, it sent Chinese stocks crashing. I'll show you what the market reaction was, what the catalyst is, and then we're going to answer the most important question. Is the U.S. next? Shocking truth is revealed. Now let's head over and pick this story up with the headline as Hong Kong stocks plunge more than 9% in the biggest fall in 16 years. And it's not just the fact that Hong Kong stocks fell, it's the manner in which they did. And their shares had their worst single day since October 2008 with a double-digit percentage losses for major industries as the highly anticipated, we'll look at this, NDRC press conference added little fresh details on China's stimulus plans, leaving investors hoping for concrete numbers to feel disappointed. But the issue here, it was on massive trading volume. And so when you see a drop in equities followed with huge amounts of volume, it means people want out. They want out in a big way. And it shows there's a lack of buyers in the market because right now everyone's starting to panic about what's going on in Hong Kong and China. And I'll show you why. As China markets warn President Xi as more stimulus is needed to fuel the rally, and we know this is what kicked off the big rally in Asian equities as President Xi Jinping came out and said there are going to be massive amounts of fiscal and monetary stimulus to support the economy. This sent stocks rallying. Then all of a sudden, there's a big backpedal here as everyone was looking to sell that move. They're saying now that's not enough stimulus, and that's one of the big issues we've been warning about is China's economy is headed into a recession and may arguably already be in one. The real estate market is a disaster right now, and then given how much money is being lent out by the banks to the real estate sector tells us that China's banking system is largely insolvent. The question now becomes is how big does the stimulus need to be to turn things around? Well, the markers are saying a whole lot bigger. But those who hope to get an answer on Tuesday were disappointed. The National Development and Reform Commission, China's economic planning agency, used the government's first briefing after a week-long national holiday to announce a meager 200 billion yuan in spending would be advanced from next year after analysts forecast a fiscal package worth as much as 3 trillion yuan in the pipeline. And that's a massive amount of stimulus. And the problem here is the market said, hey, we need more, and the market is trying to tell Beijing, look, there are structural issues with the economy right now, and a little bit of stimulus isn't enough. Of course, this then turned out that money flowed into U.S. equities today as a safety trade. But again, is the U.S. equity market safe from what's going on with China? Stay tuned, because I don't know what chairman of the NDRC was thinking with this. Frankly, the more they wait to clarify, the worse it can be because people realize there's no fiscal side to the stimulus. It's all monetary, which is propping up stocks and so forth. That's quite dangerous because the issue comes back to the Chinese consumer in a big way. But how do you make money on the markets when you see these big swings? Well, let's take you to one of our recent trades on CTA Timer Pro. This has barely been on the books for a month now, and look at this, it's at 15.21% on a trade on uranium. We gave you all the details on this trade to our subscribers. And what is our CTA Timer Pro? This is our machine positioning. When we see machines get deep short on a security and price rallies against them, it flags our report. We give the details. We tell you which ones to buy. But maybe you don't want to just beat the machines. You like trading momentum. Well, we have Momentum Timer Pro that looks at all these technical signals, aggregates them together with a proprietary overlay, and that gives us consistently a 50% win rate, even better than that. But right now we're at 50%, which is impressive. But look at CTA Timer Pro, seeing on 100% win rate. You'll know we don't have a ton of trades open right now. That's because there's shifts coming in the market. But here's the deal. You want to make money trading? We give you the daily reports. I give you the signals. I tell you my opinions on which trades you should do. We give you full backtest data on our CTA program. We're working on MTP right now, validating these signals work. Stop loss levels, full tracking, weekly updates on stop loss levels. Here's the deal. It's fully duplicatable. It's 30-day free trial. It doesn't even cost you a penny to sign up. Sign up for my buddy's stuff. They charge you. Why? Because they know you're not going to make money like you are with me. Sign up. Links in the description below. Start trading. Start making money, because policymakers probably don't feel a lot of pressure to do more than just yet But if markets start to slump on no news in the next few days, they will feel compelled to do more, because what Beijing is looking at right now is the market reaction. And what they were hoping is a surge in stocks would cause consumers to go out and buy, but it didn't actually happen. And that's one of the issues here, because we see the same thing in the U.S. markets here. Investors are looking to drive stock prices higher on the belief that consumers will spend. But the question is, are consumers going to come out and do that? Because remember, stock prices are a function of earnings. Well, to get earnings, you need people to spend money. And we see a limited chance of meaningful demand stimulus in the near term, specifically one that is geared toward consumers. Foreign investors could take a not trust but verify approach, evaluating Beijing's commitment on reflation. And that's the issue. This is coming back to the consumer. And that's why we're going to answer the question, is what we're seeing right now happening in Asia coming to U.S. markets? Many people say it can't happen. Well, we got the shocking truth for you, because let's take a look at this chart as we look at the NASDAQ 100 that's shown in red against inflation adjusted or real retail sales in blue. And what we can see here, going back to the dot-com bubble, you can see the stock market rallied as there was a slowdown in retail sales. And the next thing you know, it became very apparent that we were headed into recession. The NASDAQ rolled over and started following real retail sales down. How about going into 2007? What do we see? A broad slowdown in real retail sales. Again, the market ignored it, really believing that earnings was going to continue to drive big valuations in the market. And next thing you know, the market realized that, whoop, we're headed into recession. But look at this time, we see real retail sales largely negative for the last 2 years. And the market says, no, that's an anomaly. Things are going to get better. But what happens if consumers in the U.S. are indeed out of money? Well, that would change the entire direction of the U.S. equity markets. More data on that. But let's go back to China, because here we can see the evidence is China consumer spending lags pre-COVID era and says stimulus needed. And this is the issue, because look what happened to the U.S. economy back during the pandemic. We stuffed it full of stimulus, not just monetary stimulus, but we gave people money. That's the fiscal side of this. And what did they do? Go out and spend it. This is what the experts are saying is a problem in China, is that consumers don't want to spend. And you can't really blame them, because China is the world's largest exporter. And what's happening around the rest of the world? What are we hearing in the survey data? Demand is falling. Well, if demand from the rest of the world is going down, that means demand at China's factories is going down. And of course, you know that workers there sense that. They see it every day, and they tighten up their wallets. It's the first snapshot of how the measures announced by the government right before the break are feeding through to the consumer confidence after a bunch of piecemeal efforts failed to stem an economic slowdown. And you remember when all these piecemeal stimulus plans were coming out, what did I say over and over? This isn't going to work. It's not going to work. It's not big enough. It's not going to happen. And sure enough, none of it actually worked. And now Beijing is having to pull out the bazooka. And the markets then says, hey, that's not big enough either. The stimulus package powered a world-beating rally in Chinese stocks, despite concerns that more needs to be done to ensure demand will continue to recover. And that's exactly one of the problems with stimulus, because they can become flash in the pan. You can see some people that, well, they were looking to buy, they wanted to, and then a little bit of stimulus comes out, it just pushes them over the edge. But broadly speaking, everyone else says, you know what, that's not enough to change the situation. I know I'm concerned about my job. And that becomes the issue, because they talk about consumer confidence in China and why consumers need more confidence to drive sales. What they don't get, what they don't understand in China is the same issue here in the U.S. Confidence is the function of the labor market. You want people to spend? Give them a job and some money. And here you can see the University of Michigan Consumer Sentiment Survey in blue against the unemployment rate in red. Now, going back to the 80s, we actually saw rising sentiment and rising unemployment. But look at how that changes going forward. In 1990, as we headed into recession, the unemployment rate went up and consumer confidence came down. We then see the relationship tighten up going into the dot-com bubble. And then once again, you see it's a very strong relationship here going into the global financial crisis. And here we are back to that 1980 scenario that everyone said, hey, it's going to be okay, until it wasn't. Consumer confidence rising on the back that everyone bought into the no landing or soft landing scenario from the Fed. And now even more so based on Friday's non-farm payroll report. What do we see? unemployment rate could be the deal breaker here if we see a further increase in the unemployment rate or initial claims or continued claims or anything negative about the job market. Watch consumer confidence tumble. So the issue Beijing has that they don't really seem to understand, it's all about the labor market. And this problem is they've got enough internal demand, but people don't want to spend. You start to get the feeling here why there's this big call for fiscal stimulus. The key to boosting sentiment is fiscal policy support. The pattern since reopening has been stronger consumption during holidays, only to fade afterwards. Now, why does that happen? Because what do we see during holidays? Usually sales and discounts. So people are looking for that. We know U.S. consumers are doing the same thing. This time might be different with the change in policy tone, but only as long as China follows up with fiscal policies to nurture the fragile improvement in sentiment, something we know in terms of the fiscal side, Beijing is not interested in. So now the question is, does this happen in the U.S.? Is U.S. equity indices the major safety trade of the markets, or are we likely to see them plunging down? Let's take a look at the recent U.S. data here, because U.S. small business optimism, little change ahead of the election. And this is the shocking truth, because really people think it's all about the election, but it's not. It's not about the election at all. That's because a lot of businesses don't have an understanding of why consumers aren't out spending. They're pushing it now, say, well, after the election, people are going to come out and spend in a big way. But the question then becomes, what if they don't? The National Federation of Independent Business Optimism Index edged up 0.3 points to 91.5 after declining in August by the most in 2 years. So that means it barely changed. The group's uncertainty index rose 11 points to a record high as small business owners await the outcome of the November election. So what happens when business owners get uncertain? Well, I'll tell you what they don't do. They don't hire and they don't spend because they know money's not flowing in their pockets. 3 of the 10 components that make up the Optimism Index fell by 5, increase, and 2 held steady. The share of firms planning capital expenditure slid by 5 points to 19%, the lowest reading since April 2023. So here you can see again, lack of confidence, high uncertainty rate says business owners, well, I'm not going to spend. Maybe after the election, if people come in and start buying, I will. But for now, I'm holding off. And again, this all back feeds to the economy. Some 34% of firms reported job openings they couldn't fill, the smallest share since the start of 2021. So what are they doing? They're pulling job openings back too. Again, a sign that demand here in the U.S. is going down. You start to see what happened in China. Demand went down, talks of stimulus, sent stocks rallying, and then they plunge. Well, what happened if there's no demand here in the U.S.? You can guess where stocks might head. 23% of small business owners reported that inflation was their single most important problem, down 1 point from August, but still a top issue as elevated prices and interest rates continue to take a toll. Now, what does it mean when small business owners say inflation's a problem? What they're really saying is our customers cannot afford our prices. They're spending less or not spending at all. That's why they're saying inflation's an issue here. And among those reporting lower profits, 37% blame weaker sales. There you go. That's the inflation issue. 14% said the decline was due to prices of materials. Again, it's coming back to prices being too high. They're saying their input costs are too high that drive their prices too high, that their customers end up not being able to afford. You see the cycle here, and you start to ask yourself, is something about any of that going to change the day after the election? Well, the answer is no, not at all. Labor costs were cited by another 13%, and 11% singled out lower selling prices, again, being forced to discount to move products. That's squeezing small business owners at the margin. You see why the uncertainty index is rising. So now as we focus in and we get evidence from the business side that consumers aren't spending, well, wait till you see the credit data that came out yesterday, because it's validating that consumers are tightening their belt. And credit card debt suddenly plunges the most since COVID as APRs hit record high. And we were stunned after several months of progressively declining revolving credit growth. This from Zero Hedge, as July credit card debt unexpectedly soared the most since January, setting total consumer credit growth surging just under $27 billion the biggest single monthly increase since 2022. While they called it the last hurrah moment, now we see with consumers ever more strapped for cash and equity as the personal savings rate in the U.S. collapses from over 5% to 2.9%, this being the lowest since the Lehman bankruptcy in just 1 year, as all the excess savings from COVID are long gone, and there's only so much more credit card maxing out that can take place before reality finally sets in. And this is the moment we've been waiting for, is when U.S. consumers finally get tapped out. They say, I've got too much debt, I'm concerned about my job, and they look at their savings account and they say, that's a huge problem. And 1 month later, reality set in with a bang, because just after a month after a bizarre surge in revolving credit, the Fed reported in August total consumer credit growth plunged by more than half, just to $8.9 billion, below the $12 billion estimate. So now, after that big surge that drove perhaps the payroll report by the government to 254,000, now all of a sudden we see a huge change in sentiment in terms of credit card usage. But get this, punchline is the much more consumer outlook sensitive revolving credit, or known as credit cards, reversed all of its July surge and then some, as August saw the biggest revolving credit card drop since the COVID crash, meaning rather than spend, consumers started to pay down their debt. That is the red flag that's going to be hitting the U.S. markets here. Maybe not today, maybe not tomorrow, but it's coming soon, because the evidence that U.S. consumers are tapped out is increasingly a red flag. What happened in China, what happened in Hong Kong is coming to America. Here you can see total incomes in terms of average hourly earnings multiplied by average weekly hours of production non-supervisory employees. This showed in blue on a year-on-year rate of change against the personal savings rate in red. What do you see? Going back to the 1990s recession, you see a slowdown in incomes. Consumers got worried the economy wasn't going to boom. They started increasing their savings. Recession. You see it happen again going to the dot-com bubble. A big rise in savings backed by a decline in incomes meant no spending in retail sales. You see that happen here again going to the global financial crisis, the broad slowdown in spending. Nobody thought this could impact the economy, but it did turn into savings. That was a red flag. It started going to the pandemic, and here you see it now. The only difference is U.S. investors don't believe it can affect the U.S. major indices, but when you look at what's going on with China and their consumer spending and how the government needs massive amounts of fiscal stimulus to turn around, something they're afraid to do, you can see the reaction from global equity markets. It's only a matter of time, my friends, before that air pocket hits the U.S. major indices. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.